Let's stick with the theme of where the markets are going to go with two managers who have very different views. Larry Glazer is with Mayflower's advisors. He's long-term bullish. Keith Springer is president of Springer Financial Advisors. He's long-term bearish. However, their short-term views are also at odds with each other. Larry, you do think that we may get a correction here, short-term?
Well, Simon, we're certainly sensitive to the tremendous concerns that keep investors awake at night, and we appreciate those municipal crisis concerns, sovereign debt concerns, higher oil prices concerns. Having said that, we see ample opportunities for investors to participate in the equity markets in 2011 while still keeping an eye on protecting their principal during that period. And that bullish argument, Simon, includes a number of things. It includes corporate cash, the highest level in 50 years, virtual Fort Knox in corporate America, which makes up the U.S. stock market. It includes the presidential cycle, which has been one of the best predictive elements of future stock market performance. Whether you believe it or not, it has a great track record. And finally, Simon, we're seeing fund flows beginning to divert from fixed income. Last week, we saw $8.6 billion come out of fixed income, and we believe some of that is going to make its way into income-producing equities as an alternative for 2 years of fixed income.
Keith Springer, you are more bearish. Why?
Well, the economy is just unsustainable without continued stimulus. It's very clear. I mean, obviously, a lot of free money flowing into the economy is going to help stocks. Anybody who doesn't believe money can buy happiness doesn't know the Ben Bernanke, right? But long term, without continued stimulus, without continued money flowing freely into this economy, there's no way it can sustain itself. The biggest days we've seen on the downside have come with the best economic news, which shows you that investors don't like too much economic news to be too good, because when they have that, no more money will come in from the government. The Fed will stop stimulating, and that's the biggest fear. Once this money dries up, once the bond vigilantes come in, there's going to be no more upside to this marketplace, and you don't want to be left holding the bag. There are definite opportunities, Simon. I grant you that. Income-producing investors are very popular, or should be. There's a lot of great opportunities out there in income, but simply to be in stocks without income is really too risky. It's almost like being at the craps table. You know, you might go up, you might go down, but depending when you need to walk away from the table is going to decide how much money you have. You've got to find the niche investor.
Keith, I mean, all those are fair points. Some might look, though, at a long-term, chart of bonds and say, look, rates are just so low, even if they go up significantly, causing higher interest costs for companies, hurting profits and individuals. They're still way lower than the historical average, and you could still have a bull market with a rising interest rate environment. Do you just not buy into that?
Well, I do to some extent, but the problem is this market and this economy is very, very sensitive, Aaron, to money coming into the stock market. Every time we've had really positive economic news, stocks have sold off because the fear is interest rates are going to rise too much for the Fed to keep borrowing, or the Fed's going to decide, hey, we may not need to continue stimulating. We may not need to finish out QE2. We may not need QE3 and QE4, which this market is counting on.
Can I just say, I respect my colleague's opinion, but I disagree with it for a variety of reasons. Number one, we look at the deficit argument. The problem with the deficit argument and the problem with blaming the Fed for the issues becomes that if we look back at history, there's no evidence necessarily to support that argument.
But there is in every other country. You can't say that because in every other country, especially Europe going on now, the bond vigilantes are stepping in and not allowing that continued spending to happen.
If we look at the history of deficits to GDP in this country, go back to World War II, where deficits were twice as high relative to GDP. That was followed by a global expansion. That was followed by a stock market expansion.
But you're missing the biggest point.
Go back to the Reagan administration. Yeah, okay.
The biggest point is a demographic situation. Back then, we had a demographic situation where we had more spenders.
I actually disagree with the demographic.
We don't have that now. The baby boomers are done spending, and the next generation is a few.
I disagree with the demographic. Sometimes the demographic argument works, as it did in Japan. Sometimes it doesn't. We can fuel immigration to support our demographics in this country.
But immigration is dropping. But the biggest thing is GDP will not rise without continued stimulus, and we have minuscule GDP, 2.5%. No, but you're missing the biggest point. The next generation of spenders is years behind us.
Hey, one at a time, guys, one at a time.
Sorry, Simon.
That's all right.
The biggest thing that we've got to understand is this is the end of a generational cycle. It's not the end of America. I'm not, an un-American. It's just going to take a few years. In past recessions, you would have had this recession over quickly because there have been more spenders. The baby boomers were in the 80s and 90s were in their spending mode. Now they're past their spending mode. They have no more money to spend. They need to start saving, and they don't need more junk, more toys. It's not that they're going to spend on iPhones and some toys, but they're not going to spend like they were in the 80s and 90s.
Okay, last response there, because we're out of time.
Last response. We're in a global economy, so trade is global today. It's a very different dynamic than we look at history. So we have to recognize that, again, in a global environment, sometimes that data doesn't quite support the argument. Also, I think when we want to look at the demographic argument, we could have argued that the stock market wouldn't have recovered because of that argument, and we saw a tremendous recovery the last 2 years. So we want to make sure we're participating in that.
Okay, we're out of time. Good to talk to you both.
Okay, thank you so much.
Larry Glazer, Keith Springer, thank you very much. Have a great holiday. Thank you for your advice, sir.
Merry Christmas.
And more on buying and selling stocks.